Black Friday is upon us. Consumers already out spending, with the National Retail Federation expecting sales to increase between 3.8% and 4.2% over last year. Daniel Geltrude is here. What are some of the strategies for consumers to follow to avoid credit card debt? Daniel Geltrude is a CPA and business analyst.
I got to tell you, you have 48 million Americans that are still in debt from last year's holiday season. That is not a good way to start off this holiday season when it comes to spending. I mean, you talk about financial indigestion from last year. And I think the real big issue is that people get involved with emotional spending. You really need to ultimately have a plan for this holiday season when it comes to spending. And you got to stay away, to the extent that you can, stay away from credit cards. You know, if you don't have that discipline, use cash or use a debit card so you don't end up spending money that you don't have.
John, but people have paid down their credit card debt. Their own personal balance sheets look better this year, do they not? So yeah. Consumers understand what's right and what's wrong.
Yeah, we're talking about on average. I guess what our guest is talking about, Daniel, there's an important segment of the U.S. population that just gets itself too heavily into debt, and they have a difficult time repaying debt. You know, one of the positive factors, too, has to be that household sector balance sheets are a lot stronger because of home price appreciation. We don't have the home price deflation that we had 10 years ago. That's a positive factor. That's helping. We also have a higher personal savings rate today, and in part that's because, as I mentioned earlier, this aging population.
Go ahead, Mitch.
Hey, Dan, the credit card companies seem to be spend a fortune on advertising. Are they part of the problem in that they're putting it out there and making it very enticing, sending you cards, sending you, zero interest for the first 6 months? Are they sort of a creature of their own problem?
Of course. I mean, they're going to be encouraging what's going to help build their business, Mitch, right? So, I mean, I think they're doing what they do. I don't think there's anything wrong with that. And again, it goes back to, do you have the financial discipline to resist those types of temptations? And the people that you're talking about, I mean, they already have the discipline. They're doing the right things financially. But then again, you have this segment that get themselves jammed up year after year.
It's those darn millennials again, isn't it?
I'll tell you.
Well, to me, blaming people. I mean, let's not sugarcoat it. It's a legal loan sharking business. I mean, the interest rates that they charge, if I'm not mistaken, are higher than they were when interest rates were higher. The spread over the prime in a good economy with low default rates on cards, it's like 24% interest rates for like Amex cards. I'm not even talking about like questionable lenders and all this other stuff that goes on. And you got to want, like, why isn't this business, like, it's been the whole internet hasn't changed. They still are extorting the merchants out of these benefits to give the rewards to the consumers, and then the consumers are paying high interest rates than ever. The businesses are paying a very high percentage of the sale. Why hasn't this changed? The whole internet hasn't changed that business model.
Okay, Elizabeth Warren.
Just saying, it's fishy.
Well, that's a great question, but, that's competition, and that shows you how desperate these people are to borrow money. The demand is that strong.
Like, why mortgages go down, car loans go down with interest rates?
Well, you're talking about mortgages. It was kind of interesting. On the mortgage front, we have an unusually wide spread between mortgage yields and treasury yields now. Why? They claim it's because of the strong demand for mortgage credit, and then that spread may narrow because of competition, but that's yet to happen.
Dan, I want to bring up the holiday stocking stuffers. I want you to tell us about that.
Well, when I was a kid, I used to get U.S. savings bonds in my stocking. And to me, that was the equivalent of getting coal.
That explains everything.
That was like getting coal to me at the time. But it really wasn't that bad of a gift in the long run. But, right now, I think there are some stocks out there that are pretty good ones to be able to give as a gift. I like Disney. It's a good stock. Plus, they have a really fancy stock certificate that could make people happy. And, of course, companies like Amazon and Apple, those are really great gift stocks because I think we can count on future appreciation. It's a gift that's going to keep on giving.
The Apple credit card would be a better gift for most people. The new Apple credit card, they're a sponsor, aren't they?
Yeah, but that's only if somebody else is going to pay the bill. It's not a good gift, right?
That's the way credit cards work in my house. My kids have them, and I pay the bills.
That's the best setup that there is, isn't it, Mitch?
Exactly.
24% interest.
Right. Unless Mitch is collecting interest.
Yeah.
Dan, thank you. Dan Geltrude.